Welcome back to Simple Mindspace, where we explore the fascinating world of finance and investing. Today, we're diving deep into the wisdom of one of the greatest investors of all time, Warren Buffett. We'll be dissecting 12 common investing mistakes that even seasoned investors fall prey to. So, buckle up, sharpen your pencils, and get ready to learn how to avoid these pitfalls on your own financial journey. Mistake number 1, trying to time the market. Picture this, the stock market. A turbulent sea with waves crashing and receding. Many investors try to ride these waves, buying low and selling high. But Warren Buffett has a different perspective. He believes that trying to predict the market's short-term movements is like trying to predict the weather, nearly impossible and often futile. Even his mentor, Benjamin Graham, occasionally fell into this trap. Buffett stresses that instead of obsessing over market fluctuations, investors should focus on identifying great businesses with solid fundamentals. It's like choosing a sturdy ship for a long voyage. You might encounter storms, but the ship's strength will see you through. Mistake number 2, getting emotionally attached to your purchase price. Imagine buying a stock at $50 only to watch it plummet to $30. Frustrating, right? Now imagine another investor bought the same stock at $100. They're likely feeling even worse. But here's the thing, your purchase price is irrelevant to the stock's future performance. Whether you're in the red or swimming in green, the stock doesn't care. What matters is the company's potential for growth and profitability moving forward. Buffett advises investors to approach each trading day with a clean slate, evaluating their holdings based on current information and future prospects, not past gains or losses. Mistake number 3, falling for aggressive growth projections. Picture a company boasting about its potential for 15% annual growth. Sounds enticing, right? But according to Buffett, consistently achieving such high growth rates is extremely rare, especially for large established companies. It's crucial to approach these projections with a healthy dose of skepticism. While growth is essential, it shouldn't come at any cost. Overpaying for a company based solely on optimistic forecasts can lead to disappointing returns. Remember, sustainable growth is a marathon, not a sprint. Mistake number 4, using excessive leverage. Imagine using borrowed money to amplify your returns. Sounds tempting, but it's akin to playing Russian roulette with your investments. Leverage, while potentially lucrative, magnifies both gains and losses. Buffett cautions against excessive leverage, comparing it to having someone pull the plug on your investments at the worst possible time. Just like in a high-stakes poker game, one wrong move can wipe out your entire stack. Remember, slow and steady wins the race, especially in investing. Mistake number 5, missing the big picture by getting lost in the details. Imagine spending hours poring over financial statements only to miss a crucial red flag about the company's industry or management team. Buffett emphasizes the importance of focusing on the 3 key factors: the future economics of the business and its industry, the management team's competence, and the purchase price. It's easy to get bogged down in minutia, but it's crucial to step back and see the bigger picture. Don't let the trees obscure your view of the forest. Mistake number 6, seeking complexity over simplicity. Imagine 2 investment opportunities. One complex and challenging, the other simple and straightforward. Which would you choose? Buffett prefers the latter. He believes that investing doesn't have to be complicated. In fact, he often seeks out businesses with simple, easy-to-understand operations. Remember, complexity often masks underlying problems. Look for businesses with clear value propositions and predictable earning streams. Mistake number 7, limiting your investment universe. Imagine limiting your investment choices to a single industry or sector. What happens when that industry faces headwinds? Your portfolio takes a hit. Buffett advocates for maintaining a broad investment universe, exploring opportunities across various industries and sectors. Just like a fisherman casting a wide net, an open-minded investor increases their chances of reeling in profitable investments. Don't be afraid to venture outside your comfort zone and explore new territories. Mistake number 8, confusing activity with results. Imagine constantly buying and selling stocks, driven by the fear of missing out. This frenetic activity might feel productive, but it often leads to costly mistakes and missed opportunities. Buffett emphasizes the importance of patience and discipline, waiting for the fat pitch, an exceptional investment opportunity that aligns with your investment criteria. Remember, investing is a marathon, not a sprint. Don't mistake activity for progress. Mistake number 9, over-diversifying your portfolio. Imagine owning dozens, even hundreds of stocks in your portfolio. While diversification is crucial, over-diversification can dilute your returns. Buffett believes that investors who thoroughly understand a handful of businesses can achieve better returns than those spread too thin. Think of it like this. It's better to own a few valuable pieces of art than a garage full of trinkets. Focus on your best ideas and let your winners run. Mistake number 10, succumbing to confirmation bias. Imagine clinging to a losing investment, seeking out information that confirms your initial thesis while ignoring contradictory evidence. This is confirmation bias in action. Buffett and his partner, Charlie Munger, acknowledge this common human flaw and actively combat it by seeking out dissenting opinions and challenging their assumptions. Remember, objectivity is key to making sound investment decisions. Be willing to change your mind when presented with new information. Mistake number 11, blindly following the herd. Imagine buying a stock simply because everyone else is doing it. This herd mentality often leads to irrational exuberance and eventually painful losses. Buffett prides himself on his ability to think independently, avoiding the emotional contagion that grips the market during periods of euphoria or panic. Remember, contrarian thinking can be your greatest ally in investing. Be skeptical of popular narratives and seek out undervalued opportunities. Mistake number 12. The sin of omission. Imagine missing out on a fantastic investment opportunity because you were too afraid to act. This sin of omission can be even more costly than making a bad investment. Buffett himself admits to missing out on billions by failing to pull the trigger on promising opportunities. Remember, inaction can be as detrimental as action. Don't let fear or indecision paralyze you. When you identify a compelling opportunity within your circle of competence, seize it. Those are 12 of the most common and costly investing mistakes, as identified by Warren Buffett. By understanding these pitfalls and adopting a disciplined, long-term approach to investing, you can increase your odds of achieving financial success. And there you have it, 12 valuable lessons from the Oracle of Omaha himself. By recognizing and avoiding these common investing mistakes, you'll be well on your way to building a solid financial future. If you enjoyed this episode, don't forget to like, share, and subscribe to Simple Mind Space for more insightful content. Until next time, happy investing.